Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. On Wednesday, November the 23rd, the Reserve Bank will review the official cash rate for the last time this year. The OCR is now at 3.50%, with the Reserve Bank having already increased it by 275 basis points so far in 2022. Another OCR increase is expected on November 23rd. That's against the backdrop of the highest consumer price index inflation in more than 30 years, most recently weighing in at 7.2%. Despite borrowers facing sharply higher interest rates, with, for example, the average bank 2-year mortgage rate now around 6%, up from about 2.5% in July 2021, and price rises for essential items such as food, which rose 10.1% in the October year, the labour market remains buoyant, with unemployment at just 3.3%, and an annual 8.6% rise in private sector hourly wages. To discuss all this in a monetary policy episode, I'm joined by Kiwibank Chief Economist Jarrod Kerr. Hi Jarrod, and welcome to the Of Interest podcast. It's great to have you with us.
Kia ora, and thank you for inviting me to speak.
So firstly, let's look ahead to November the 23rd, so that's the OCR review. What do you expect the Reserve Bank to do and say?
I think they will hike by 75 basis points, taking the cash rate to 4.25. It is an aggressive move, but the war on inflation is far from over. We have seen inflation rates globally peaking, and it looks like inflation will decline from here. But the pace, the deceleration back towards price stability is going to take some time, and I think central banks feel they have a lot more to do to ensure that inflation returns to 2%. On top of all of that, we have a lot of volatility in financial markets. We have house prices declining, and households are still fighting a significant increase in the cost of living.
Absolutely. So how does your expectation tie in with the overall financial market consensus of expectations for November 23rd?
Yeah, look, the market had a full 75 basis point hike priced in, and it seemed to be a bit of a done deal. Most economists and market commentators are of the view that the Reserve Bank will deliver 75 basis points. They discussed a 75 basis point move in October, and I think it's become more compelling since then, so we are likely to see it. But just over the last week, we've seen a weaker inflation print in the United States, which has the market, I think, excited that the Fed may slow their pace of tightening, and that's fed through to markets here. So a 75 basis point hike next week is actually not fully priced anymore. It's come back a little bit, and it will be interesting on the day. We will get a reaction either way.
Absolutely. And look, I mean, I mentioned in the beginning, that the OCR has gone up 275 basis points so far this year. You're talking another 75. That's a very significant increase in just the 1 year. Just wondering if we could just have a little chat about what is this higher OCR supposed to be achieving, and what evidence is there thus far that it is doing what it's meant to be doing, or is it too soon to make a judgment on this?
No, it's not too soon. I think we are seeing the impact coming through now, and I think it's going to play out over the next 6 months. We're going to see, I think, a substantial decline in household consumption. So what is the point of these OCR hikes? Well, last year I think it was very clear that we had an economy that was running hot, particularly with the housing market. House prices were up over 30% in just 1 year, in the year to August, and the economy was doing remarkably well with a very tight labour market. Wages were expected to increase; they have increased, and we've seen a significant uplift in inflation pressure. So to put it simply, the Reserve Bank is trying to restrain demand. It's actually trying to reduce demand down to where the economy can supply it. We have had issues with the supply side of the economy, and that's a global issue as well. And we've seen a lot of inflation being produced globally because of the surge in demand we saw during the COVID pandemic, as central banks not only reduced interest rates, they printed a lot of cash to further reduce interest rates by buying government bonds, and you had governments coming out with very loose fiscal policy, trying to pump up their economies, and they did a good job. New Zealand did a good job with the wage subsidy. That clearly helped, but we've seen trillions of dollars effectively worth of monetary policy and fiscal policy globally to try and offset the impacts of the COVID pandemic. And we've now seen a significant demand shock, and that has caused a real uplift in inflation to rates we haven't seen since the 1980s. So central banks are fighting inflation. It's a fight they haven't really had to get involved with in recent decades, not to the extent that they are now. And we've seen 90 central banks globally lift interest rates in the last year to fight inflation. So it really is a global theme. And the Reserve Bank of New Zealand was one of the first to start lifting interest rates in October last year. But as you know, better than anyone else, interest rates, they work with a lag. So they started lifting interest rates in October last year. That wasn't felt immediately by households. Most Kiwi households with debt, with mortgages, are on fixed rates, and they fix for 1, 2, 3, sometimes five years. But most people tend to like that 1 to 2 year rate, and that is one of the most attractive rates that are offered by banks. So people follow price, and it's simply cheaper to do 1 and 2 years. Now, the majority of mortgages are coming up to be refixed, and that's happening now. So that the majority of mortgages are coming off very low, extraordinary low interest rates, record lows of last year, and they're coming on to much higher interest rates. And in the back of the Reserve Bank's mind, that by design, this is exactly what they're wanting to see. That they're wanting to see households' consumption ease, and that they wanted to see the housing market turn around, and that's exactly what they've engineered.
I thought it'd be good just to drill a little bit more into what's going on with inflation. So the latest Consumers Price Index inflation release from Statistics New Zealand, as mentioned previously, had 7.2% annual increase. So if we break this down a little bit, so the tradable items, so the ones impacted by international price movements and exchange rates, were up 8.1%, and the non-tradables, so supposedly the goods and services not exposed to the international factors directly, were up 6.6% year on year. And we just saw more recently than that, the Reserve Bank's own inflation expectations survey, and that had expectations for inflation in 2 years' time rising to 3.62% from 3.07%. I just wonder, what's your sense of where the Reserve Bank's inflation battle is at?
Yeah, it's a good question, and just to put some of those numbers in context, the headline inflation rate of 7.2, as you say, is a bit of a disappointment. Inflation looks like it's peaked at 7.3%, but the market, ourselves included, were expecting that headline rate to fall further into the sixes. It didn't happen. We saw upside surprises to tradables inflation, so the imported inflation was much higher than we anticipated. And the domestically generated inflation, that non-tradables inflation that you mentioned, was also stronger than we thought. So inflation across the board, although it looks like it's improving slightly, it is much more frustrating than what the RBNZ would like to see. and the path from 7.2% back down to the RBNZ's target of 2% just seems that much further away. So this is exactly what the Reserve Bank is confronting and trying to deal with. And then you have the behavioural side of it, the expectations of where inflation is going to be in the future, and that they have all been revised higher. Those expectations from businesses and analysts like myself have all been revised higher. And expectations simply follow actual inflation outcomes. So when inflation outcomes surprise on the upside, as they did in the last reading, then people's expectations of where inflation is going to be over coming years is also lifted naturally. And that's a frustration for the central bank. So not only are they failing on their mandate at the moment, inflation's miles away from their targeted 1 to 3% band where they focus on 2%. The expectations of households and businesses have lifted. That actually points to the credibility of the central bank itself. When you have analysts and businesses and households all expecting inflation to be much higher for much longer, effectively suggests that the Reserve Bank isn't doing its job and will struggle to get inflation where it needs to be in coming years. So the Reserve Bank will not like that. The Reserve Bank will react to it, and this is why we're expecting a 75 basis point hike next week, which is aggressive, but look, their credibility is in question.
And that, just to note, that 7.3% peak you mentioned was, of course, the Consumers Price Index for the June quarter, the prior to the September quarter. So perhaps that's the peak. I guess we'll have to wait and see. Now, yesterday I had a look at your Kiwibank Economist's weekly first view note that you put out every Monday. And you looked at the drop in the Consumer Price Index or CPI inflation report in the United States last week, which you mentioned earlier, and you highlighted the lower core inflation in that, which with core inflation excluding the volatile food and energy prices. I'm just wondering how closely is core inflation tracked by the Reserve Bank in New Zealand, and how is it looking here?
Oh, look, they are inflation fighters, and they look at all measures of inflation, and core inflation is an important read. It gives you a better sense as to how inflation is tracking when you exclude the volatility of some of these price moves, like we've seen in food and energy or petrol, and you're trying to get a handle as to where inflation is likely to track. The core measures are preferred by central banks, even though their mandate is to target headline. They obviously look at core in great detail. So the core readings in New Zealand are frustrating, to put it politely, whereas the core reading that we saw in the US last week was actually a pleasant surprise. And I think we'll see inflation rates over the next 6 months continuing to decelerate, but it's the speed at which will I think frustrate central banks a little bit further.
Of course, the Reserve Bank's monetary policy remit also means it has to target something that's known as maximum sustainable employment, which relates to the labour market. For the removal of any doubt here, we're not talking about a specific level of employment or unemployment. Can you just give us a little brief explanation of what do they mean by maximum sustainable employment, and what their view is on where that currently sits?
Yeah, so at the moment, right now, we're at a level which is clearly above sustainable employment, and that's demonstrated through the rise in wages. So the labour market is so tight that we're seeing a lot of wage inflation being generated. So the Reserve Bank knows that the level of employment or the level of unemployment is such that that we're generating a lot of wage pressure. So for them, a higher unemployment rate or lower levels of employment are desirable. It's simply the Phillips curve that we look at. So famous Kiwi economist Bill Phillips, first put together this curve, which is the relationship between unemployment or tightness in your labour market and general inflation or particularly wage inflation. That relationship, and that is what they're trying to target. So they have an inflation target on one hand and a employment or unemployment target on the other hand. It is the Phillips curve, which all economists learn very early in their studies, and most of us have it tattooed on our shoulder somewhere.
Have you got one, have you?
I tell people I do, but I don't.
Okay. So I guess in terms of this maximum sustainable employment then, does the Reserve Bank effectively need unemployment to rise? They need more people to lose their jobs and wage rises to slow down quite a bit so that they can meet their inflation target?
Yeah, exactly right. So the labour market is too tight. We're generating too much wage inflation. So from the central bank's perspective, they're trying to free up some capacity in the economy. So it sounds a little brutal to say, look, we need a rise in unemployment, but I think what they're trying to orchestrate here is clearly a slowdown in the economy, so that we produce less in the way of inflation. And there are, unfortunate trade-offs in this. I don't think there's any way of hiding around the fact that lifting interest rates the way they have it is not going to have a significant and damaging impact in parts. So there are going to be households that really struggle, or that they already are struggling at the moment. And there are going to be businesses that struggle under higher interest rates as well. And that is by RBNZ design. They are trying to slow the economy down to get inflation back to where it needs to be. Because if they don't, then the consequences of having very high inflation for a very long time are far worse. It means you have to tackle this greater problem down the track and potentially cause larger contractions and issues in the economy.
So it's sort of a case of take some pain now to avoid more pain later. Is that really what they're trying to achieve here?
Yeah, well, you've got to get inflation down. You can't let it run the way it is for too long. It erodes people's purchasing power. It obviously hurts savers, and has negative consequences for the economy over the longer term. So it's better to, as you say, take the medicine now, get it over and done with as soon as possible, get things back to closer levels of normal sooner rather than later. Because let's face it, policy was very, very effective during the pandemic, and arguably, with the benefit of hindsight, monetary and fiscal policy did too much in the end, and we're now having to tackle the problems that have been generated from that excessive liquidity.
Just in terms of the labour market, I mean, obviously the issues we're facing in New Zealand, we're seeing in other countries as well. Notably, we've already mentioned the United States. Australia's got a very tight labour market now too, and others as well. We have been through this pretty unique scenario with the COVID-19 pandemic in the last couple of years. And I heard quite an interesting interview with economist Isabella Weber a few days ago, and she was arguing that we're effectively recalibrating the economy back from a wartime economic setting. And if you look at everything that's been at play with the disrupted global supply chains, the lockdowns, closed borders, the wage subsidy scheme you mentioned, people working from home, it's been a very tumultuous period. I saw a separate article from the Financial Times with it was an opinion piece, and the author was arguing that we've a 40-year era of cheap money, cheap labour and cheap energy has come to an end. So, I mean, I guess against this sort of backdrop, there are some quite big questions I've been pondering. Have the drivers of inflation changed? Has the labour market changed in ways we don't fully understand yet? Or is it just taking its time to come back to something we understand better from the pre-COVID era? And I mean, is the Reserve Bank's monetary policy still fit for the purpose it's designed for? I'm just wondering if you have any thoughts on all of this.
Yeah. Look, I'm an economist. I got lots of thoughts on all of the above, and it is fascinating times from an economist's point of view. We've been through an incredible shock, the COVID pandemic, and as you say, it exposed a lot of things. The impact on global supply chains. The argument that it's accelerating deglobalization. The point that you raised before, I can't remember who said it, but the fact that we've gone from a wartime setting is very true. In the middle of the pandemic, I remember having conversations around exactly that. We were trying to find points in our history that looked close to what we were going through, and you really have to go back to wars, times when you actually close your borders and extreme events like that. You're basically going back to World War II, and then you're looking at the Spanish pandemic and World War One, and you're looking at some really challenging times, and it was a very challenging time that we went through. And I think there have been a number of changes to our economy since that. And you mentioned a big one, which is the ability to work from home. And I also linked that with the increase in the digital economy. So we were already on a path to more digital, pathways. But what happened over COVID was we basically accelerated the use of technology rapidly, like within months. So as a bank, we couldn't get enough EFTPOS terminals out the door fast enough for companies that would have otherwise used cash. We couldn't get enough credit cards and that for people who didn't have a means of click and collecting. So there was a huge take up in technology, so that accelerated that trend that was already in place, and along with that, none of us knew what a Zoom or a Teams meeting was a few years ago. Now we use it daily, and many of us have the ability to work from home. We have a much more flexible workforce, which is much healthier and more efficient. We're seeing levels of traffic that are still lower than pre-COVID levels, which is fantastic. I think that is a result of better allocation of people's time and effort. So more people working from home, less traffic on the roads. The other point that you mentioned there about 40 years of easy money, being wrong or coming to an end. Let's not forget the massive demographic impact of the baby boomers and what that did, but also the rise of China and other economies in reducing inflation globally. So that's been the theme for a long time. And yes, I think that is turning around now. I think the demographic impact on interest rates is now swinging the other way. And China's impact is obviously not as much as what it was. I think we will see, from now on, higher rates of inflation than what we've been battling in recent decades. So that central banks have gone from fighting inflation fiercely in the 70s and 80s to worried about threats of deflation. Now they're facing inflation again. So I think, to your other point, are central banks capable? Are their tools right? I think central banks are definitely capable, and we'll see the impacts of what central banks have done coming through in the next 6 months, much lower global growth and hopefully a turn in inflation. Their tool of a interest rate is very blunt, but it works. They've also sharpened some of the other tools in their toolkit around macroprudential policies and other things. So I think we'll see more of the other tools that central banks have. But one thing that the pandemic has taught us, and I think has been missing for a long time, particularly after the 2008 financial crisis, is the fact that government policy, government response can be much more targeted and much more effective in time of crisis than simply slashing an interest rate. Slashing an interest rate from the central bank works, but you can get much more targeted policy through the government. And if you think about the 2008 crisis, it was pretty much all monetary policy response to it, a little bit of fiscal, but not a lot. And then we saw fiscal austerity, which was precisely what wasn't needed following the 08 crisis. And I think one of the main reasons why interest rates got so low, record lows of last year, was the fact that governments hadn't actually done a lot of investment over the last 10 years. They haven't actually, done a lot. They hadn't made use of the lower interest rates. So I think that was a big reason why we had very low interest rates, very low inflation. But now, fiscal policy has proven itself and how important it is going forward.
It's a good, very good point, and leads nicely into my next question, which is, do we need to see more from government fiscal policy, indeed, to help in the inflation fight?
Yeah, I think so. I think that the government can play a part. There are things they can do, as we've seen with excise taxes and more payments to families to help with the cost of living crisis. But I think more medium term and long term, I think in New Zealand in particular, we need to maintain a very sharp focus on infrastructure in this country. I think the underinvestment in infrastructure in New Zealand over recent decades is a big cause of many of the problems that we face at the moment, particularly in the housing market. So more needs to be done around freeing up land, firstly, and getting the infrastructure to that land to boost the supply of housing. I know a lot has been done, but obviously a lot more needs to be done. We still have a chronic shortage of affordable, healthy homes in this country, and I think that alone is a big reason why we've struggled in our productivity and with lifting living standards in this country.
Okay, I thought a good way to wrap this up, Jarrod, would be to sort of cast our thoughts and eyes ahead. So after next Wednesday, the 23rd of November, the Reserve Bank is not scheduled to review the OCR again until February the 22nd. So that's a big summer break. So I'm wondering, let's assume they do the 75 basis point increase next week as you're anticipating. What will they then want to see before their next review on February the 22nd? And, where do you see this OCR cycle peaking? And also, what do you anticipate the economy being like next year? Because you've mentioned the OCR as a blunt tool. What sort of fallout are we going to see from these hikes?
Yeah. So firstly, your point on the fact that the central bank meets next week and then doesn't meet for another 3 months is a key point. So it's one of the reasons why we're expecting a little bit more front loading and why we think we'll see a 75 basis point hike because they don't come back for quite some time, whereas other central banks keep chipping away over coming months. So that I think's a reason why they do a little bit more and then wait and see. And I think over that 3 months will be really interesting. I think we will have seen a significant slowdown in household consumption. Interest rates are hitting people now, so we will see that coming through in the data, that economic pain from the central bank tightening. We will get a better handle on just how impactful those rate rises have been, and I think they've been substantial. We'll have more housing market data, which is important. We got the latest REINZ numbers just this morning, and they've seen a large decline in house prices, so that will continue. We think house prices will fall by around 15%. That of course feeds through to household confidence and their perceptions of how the environment is. What will they be looking for? Well, all of the above, basically. They'll be looking for inflation, number one. We'll get another inflation print, and hopefully that is a step in the right direction. And all the other indicators around price pressure will be looked at closely. They'll be keeping an eye on the labour market. Obviously, it will remain tight, and we will see further wage pressure. So there's a few conflicting things that they'll be weighing up. But I think more importantly, we will have seen further signs of slowdown in global growth and hopefully inflation. So the international picture will become clearer by the time they come back in February. So I think they tighten again in February, and I think they lift the cash rate to 5% before they're done. But we will see a further turn in their commentary around what's happening globally and locally, and will be called an RBNZ pivot, so to speak, when they start to slow down tightening and signal a peak in interest rates, which I think will occur early next year. And then I'm of the belief that by the end of next year, I think enough would have been done that we'll actually be in a situation where central banks, including the RBNZ, will start to ease monetary policy into 2024. So more hikes, more pain near term, a cash rate of 5%, which obviously sees mortgage rates staying around current levels, if not a little bit higher. And then hopefully by the end of next year, the war on inflation will be won, and we'll see central banks starting to reduce interest rates.
Well, look, Jarrod, thanks a lot for that. It's a really interesting discussion always, monetary policy and where the Reserve Bank is heading and what that means for the rest of us. That's Jarrod Kerr, Chief Economist at Kiwibank, and I'm Gareth Vaughan at interest.co.nz with another episode of our Of Interest podcast.